Welcome to PIMCO Pod. In this episode, we discuss how a confluence of rising sovereign debt, surging AI-related corporate bond issuance, and inflation concerns has lifted the 30-year yields in the U.S. and elsewhere to two-decade highs. Stay tuned after the conclusion of the podcast for additional important information. What's Pushing Long-Term Bond Yields Higher? By Mark P. Seidner, Pramod Dhawan. The 30-year U.S. Treasury yield has touched roughly 5.3% in the past week, a level not seen in nearly 2 decades. Global counterparts in Europe, the UK, and Japan have climbed to similar heights. What's driving the move at the long end of the yield curve? Rising sovereign debt loads, a surge in AI-related corporate bond issuance, and lingering inflation anxiety tied to energy costs, and what that means for central bank policy, all play a role. Our colleague Lotfi Karoui explored a related question in June amid the influx of bonds tied to the AI build-out. See the credit market lens. AI financing needs do not override cyclical drivers of yield. AI-linked issuance, much of it longer dated, has grown large enough to compete with government bonds for investor capital, even if it does not appear to be the dominant driver of yields. A key question is how fully the AI effect is priced into markets at this point. The recent volatility has largely been a real yield event. Break-even inflation rates, market gauges for expected average inflation, have stayed comparatively stable even as nominal yields marched higher. That suggests investors aren't demanding a much larger inflation premium. The sovereign debt trajectory and the bond vigilantes. The sovereign bond repricing has been global, and rising government debt levels remain central to market concerns. Amid the repricing, German 30-year yields have reached post-2011 highs, and French 30-year yields have risen to their highest since the global financial crisis. In Japan, 10-year yields are the highest in 3 decades. Rising deficits are a common problem across developed market (DM) economies. This week, total U.S. government debt crossed $40 trillion, according to the Treasury Department, more than doubling over the past decade. Amid increasing long-term borrowing costs, the Treasury Department said on August 19th that it will at least double its planned buybacks of outstanding 10-year to 30-year debt. In our most recent secular outlook, Rupture and Resilience, we said we expected episodic volatility rather than a sudden fiscal crisis as markets periodically refocus on debt sustainability. That framing remains relevant. We made a related point in this column in December 2024, Thoughts from the Bond Vigilantes, noting that rising deficits had made us less inclined to lend to the U.S. government at the long end. While capital flows and foreign exchange adjustments could serve as a release valve, deficit reduction is the only durable anchor for long-end yields, in our view. In the U.S., the deficit has become largely inelastic to underlying economic need. Rising sharply even in a strong economy, across DM, we see little appetite for fiscal austerity. Rising term premium and potential risk factors. Part of the investor caution in the U.S. reflects the 30-year bond structure. It's a less liquid area of the Treasury market than the 10-year note, and it reacts significantly to shifts in sentiment around fiscal credibility. The 10-year note, by contrast, is a widely used benchmark anchoring mortgage rates, corporate borrowing costs, and the broader cost of capital. Even as the long bond grabs headlines, the 10-year yield has held within the 3.75% to 4.75% range that has served as our reference point for several years. A few factors help explain why this range has held. One is a recent softening in economic data, including a weaker-than-expected employment report and inflation readings below consensus. For more, see our August 5th macro signposts, underlying inflation gauges, trimming noise or trimming signal. In addition, a large short base in the U.S. rates market may help limit any disorderly rise in yields, while Treasury buybacks appear supportive of bonds at top end of yield ranges. Key risks that could propel yields to a higher range would include additional fiscal stimulus in an economy that does not need it, and further deterioration of expectations around government debt supply. The relative underperformance of the long bond has steepened yield curves and increased the term premium, the extra yield investors demand to hold longer-dated securities. Barring an unexpected economic downturn, we expect this higher term premium to endure. A bumpy ride toward improved opportunities. It's worth noting that even after the recent rise, yields on longer-dated treasuries and other sovereign bonds are essentially back near their long-run historical averages. Today's yields only appear unusually high relative to the artificially suppressed rates of the post-global financial crisis era. Watching yields grind higher can be a difficult process, but higher yields may ultimately benefit investors through greater potential income generation. In 2022, starting yield levels were too low to offset price declines as rates moved higher at a rapid clip. Today, attractive inflation-adjusted starting yields may provide ample income to offset price declines related to recent market moves, and broader bond market performance remains resilient. At PIMCO, we've spent more than 5 decades navigating rate cycles. Our experience has taught us to remain humble, to respect the power of market forces, and to keep a long-term perspective. From our perspective, current yield levels look increasingly appealing by historical standards, offering a compelling entry point for long-term investors. We continue to view bonds as attractive and would look to add if yields continue to rise, given the opportunity higher yields present for income, carry, and rolling down a steeper yield curve. Thank you for listening. That was What's Pushing Long-Term Bond Yields Higher? For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.